There is an important question about trading indicators that comes up quite often for beginner and advanced traders. Which indicator should you use, and what are the best settings or look-back periods to use? In today's video, we'll address those questions and you'll learn how to adjust your favorite indicators to suit your trading style. Trends cycle from low volatility and relatively infrequent momentum reversals to high volatility and frequent reversals. Ideally, you would have a system or indicator that would warn you of the type of cycles that will be made in the future. Unfortunately, no such system exists. There isn't a bulletproof method that will project in advance when a market is going to be in a trading range or a consistent trend. So occasionally, you may want to adjust the settings for an indicator to reflect the most recent momentum volatility. That's because for any given indicator, there will usually be different settings for different markets and usually different settings for different time frames of the same market. The primary setting for any indicator is the look-back period. Now, the look-back period is the number of bars back from the most recent bar that the indicator looks at in order to make the calculations. It's the number of bars prior to and including the most recent bar the indicator will use to plot the results. So let's discuss the look-back period using several indicators as examples. You can use any indicator you want, the principles are the same. Let's start with a look-back period on moving averages. Everyone is familiar with a simple moving average. It's the average price of the past X number of bars, usually the close. The look-back period is the number of bars used to calculate the moving average. A longer look-back period will be less sensitive to price changes than a shorter look-back period. It will take a longer period of recent momentum change to influence the longer look-back period. The upside to the longer period is there should be fewer false reversals made by short-term price changes. The downside of the longer look-back period has the potential for a lag between price and momentum reversals. Price may have made the reversal several bars before the moving average makes the reversal. Now, this is the most important concept you should always remember. It doesn't matter the indicator, whether it's a moving average, the RSI or the MACD. Smaller settings lead to more sensitive trading indicators and will produce more signals. However, smaller settings will make the trading indicator less reliable. Larger settings give more reliable but less frequent signals, and indicators with larger settings lag. So there is a spectrum of settings for indicators. On one end, sensitive but unreliable. On the other end, reliable but lagging. Now let's analyze the stochastic settings to get a better idea on how you should adjust the look-back period. We'll begin by looking at the same data with two different stochastic look-back periods to see which may be more useful. The stochastic is designed to oscillate between 0 and 100. The indicator is mainly used for determining whether the price has moved into an overbought or oversold area, and traders also use it for crossover signals and also for divergences. So let's see if we can find those signals. Looking at this example, two things are immediately obvious. While the first indicator oscillated nicely with the price swings, most of the momentum reversals didn't reach the overbought or oversold zone. For a two-line indicator like the stochastic, both the fast and the slow line must be in the overbought or oversold area. Now, I don't trade a lot of overbought or oversold levels, but a lot of traders are focusing on those levels. So if an indicator has an overbought or oversold zone, you want to use it to your advantage, and ideally, use a look-back period so the indicator reaches the overbought or oversold zone most of the time before a momentum reversal is made. As you can see, the second look-back period is more suited for those settings. The second important factor is that most of the momentum reversals, which are made when the fast line crosses above or below the slow line, were made several bars after the extreme swing high or low, and after the price has moved a significant distance from the high or the low. If a momentum reversal is part of your trading plan, stops would typically have to be a long way from the entry price if you use a relatively long look-back period. So the first look-back period is probably too long to use for this strategy, because both lines of the stochastic indicator usually don't reach the overbought and oversold zones before a reversal is made, and the lag from the price reversal to momentum reversal is usually quite high. Now let's focus our attention on the shorter look-back period. There are a couple of obvious factors from this data in indicator chart. First, at the price highs and lows, the momentum reversals tended to be made in the overbought and oversold zones. For any indicator, a relatively shorter look-back period will always result with the indicator making momentum reversals very close to the price swing highs and lows. This would seem to make the shorter look-back period ideal. However, the more timely signals come with a cost. A shorter look-back period will usually have lots of false momentum reversals, and very short-term momentum changes cause an indicator reversal that is quickly reversed once again as the trend continues. Observe these several areas on the indicator window when the stochastic became choppy and gave momentum reversal signals that were again reversed within a bar or two. Too short a look-back period will produce too many momentum whipsaws. There must be a reasonably middle ground, and there usually is. Here is the same example, but with a 13-period look-back period added. You can observe that the indicator reaches the overbought and oversold zone at most of the momentum reversals. The momentum reversals are within a couple of bars of the price highs and lows, and there are no false momentum reversals between the overbought and oversold zones. Of the 3 look-back periods we have looked for this data, the 13 period seems the best. Remember, for this particular market and for this time frame. Let's say you prefer trading with the RSI, and your trading style relies on finding divergences and trend trading. And let's take a look at this example in order to analyze several RSI periods in action. The first 2 RSI settings were able to spot a classic divergence, while the smoothed RSI with a longer period was unable to find it. If you were trend trading, the first RSI would have offered many false signals. Also, the second one performed better during choppy price action. The third one was the less responsive to market noise, and possibly the better one to use during this movement. So if you prefer to trade divergences, and you want to have a higher number of signals when you trend trade, then lower settings on the RSI will suit you. If you are a swing trader or a position trader and want to eliminate market noise, then higher settings on the RSI will help you to do that. A lot of traders look for the perfect settings on their indicators when they trade. The reality is that there isn't one. You just have to know your trading style. You then have to backtest different settings depending on the market you are trading and the time frame you are analyzing. This is how you decide which settings or look-back periods to use. It's very simple. Test a few settings on recent data and see which best meets your criteria. Now the question is, once you find the settings best for the recent data for a given market and a given time frame, will those settings ever change? Of course they will. There isn't one best set of settings for an indicator that you will use all of the time. There will be periods when market volatility and momentum cycles will change, and the indicator settings you have been using will be much less useful. So here's how it works. Look at a series of data for any market and any time frame. Test out a few look-back periods for your favorite indicator over 2 or 3 different periods of time for the data, and choose the most useful settings. Assume that these settings will continue to be useful. You can never know if the volatility and the momentum cycles will change in the future. You have to assume they will continue. If a market changes trend speed and volatility in the future, and the best settings you have found in the past are no longer optimal after a few cycles, you may need to shorten or increase the look-back period. This is a quick and easy process to find the best settings for any indicator in any market or time frame. Also, before adjusting the settings, first you must consider what you want to do with your indicator. For trade triggers, for example, smaller settings work because they don't lag and are able to pinpoint trade entries. For example, to use prices closing above a 3-period simple moving average as a long trade trigger is reasonable for a short-term moving average. However, using a 3-period moving average to figure out the market trend is irrelevant. The average of the past 3 prices hardly sums up the market trend. In this case, a longer-term moving average is more suitable for assessing the market trend. The 50 or 200 period simple moving average, for example, are better suited as long-term trend filters. So before changing the look-back period, you must know what you want your indicator to do. The best settings for the trading indicators depend on your understanding of the indicator, your goal of using the indicator, and you as a trader. If you don't know how to use the indicator and interpret it well, the settings of the indicator won't make too much difference. As always, if you learned something new and found value, leave us a like to show your support, subscribe to our channel and click the bell icon to stay in touch when we upload new videos. Until next time.